How does a $1.2 billion refinancing package impact one of the largest shopping centers in Dallas? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In a significant financial maneuver, JLL's Capital Markets Group has orchestrated a massive $1.2 billion refinancing package for NorthPark Center, a prominent shopping destination in Dallas, Texas. This transaction was spearheaded by Wells Fargo, with Morgan Stanley and Goldman Sachs also playing pivotal roles in the financing arrangement. Representing NorthPark Management Company, which is owned by the Nasher/Hamiseger family, JLL facilitated this refinancing. The funds from this refinancing will be strategically utilized to retire the existing mortgage and to redeem the equity interests in NorthPark Center, thereby restoring full ownership to the Nasher/Hamiseger family. NorthPark Center, which opened its doors in 1965, is celebrating its 60th anniversary. It spans a substantial 1.9 million square feet as a Class A++ super regional shopping center, housing over 190 tenants, including 75 market-exclusive retailers. It maintains an impressive occupancy rate of 98.6%. Among its anchor tenants are renowned names like Neiman Marcus, Nordstrom, Macy's, Dillard's, Eataly, and an AMC 15-screen theater. The center's prime location at the intersection of Northwest Highway and US 75 ensures it benefits from excellent accessibility and visibility, attracting both regional and international visitors. It's nestled near some of Dallas's most affluent neighborhoods and significant employment hubs. NorthPark Center is not just about retail. It uniquely integrates art and culture into its shopping experience. The property showcases over 50 pieces of modern and contemporary art from the Nasher/Hamiseger collection, alongside additional works on loan from prestigious institutions such as the Nasher Sculpture Center. JLL's Timothy Joyce, Trey Morsbach, and Matt Maximek were the lead advisors on the debt team for this transaction. Timothy Joyce commented on the refinancing, highlighting that it underscores the enduring strength of premier retail assets in major markets. JLL's Capital Markets Group continues to provide comprehensive debt, equity, and investment advisory services to real estate clients globally. In a strategic move to solidify its presence on the West Coast, an East Coast retail landlord has acquired a 10-property portfolio of shopping centers. This acquisition is part of a broader plan to establish a regional office hub, reflecting a significant investment in West Coast big box retail. According to CoStar News, the portfolio was acquired from Merlone Geyer Partners, with the transaction being facilitated by DLC Management Corporation in collaboration with DRA Advisors. The shopping centers included in this acquisition span various locations, including Alderwood Plaza in Linwood, Washington, and Lake Forest Park Town Center in Lake Forest Park, Washington. Other properties are located in California, with notable sites such as 24,312 Rockfield Boulevard in Lake Forest, 4,821 Claremont Drive in San Diego, and 458 Howe Avenue in Sacramento. This move not only expands the landlord's footprint, but also marks the opening of a new regional office in Las Vegas, Nevada. The strategic positioning of these centers allows the landlord to tap into the growing retail demand on the West Coast, enhancing their market reach and operational efficiency. Adam Ifshin, Chief Executive Officer of DLC Management Corporation, has been instrumental in this acquisition, underscoring the company's commitment to expanding its national presence. The deal highlights the ongoing trend of East Coast companies investing in West Coast commercial real estate to capitalize on the region's robust economic growth and retail opportunities. FBL Commercial Realty has officially launched in Florida, marking a new chapter in the state's commercial real estate landscape. The boutique brokerage is the brainchild of industry veterans Tommy Frankel, Brad Ball, Eric Levitt, and Rob Steiner. Located at 3535 Military Trail No. 101 in Jupiter, Florida, the firm is a partnership between Frankel and Ball, co-owners and brokers of Frankel Ball Realty, and Levitt, managing partner of EML Realty Partners. The brokerage aims to offer a personalized, hands-on approach to a full spectrum of commercial real estate services. This new venture serves as the commercial arm of Frankel Ball Realty. EML Realty Partners will continue its focus on acquiring and managing value-add commercial properties throughout Florida, with a particular emphasis on industrial properties. FBL Commercial Realty consolidates decades of experience and billions of dollars in real estate transactions, positioning itself as a one-stop shop for clients seeking premier commercial brokerage services across the state. Eric Levitt expressed his enthusiasm for the new venture, highlighting the complementary skill sets that each partner brings to the table. "I'm very excited to start this commercial brokerage venture with Tommy, Brad, and Rob," Levitt said. "We all bring three very different skill sets to the table that will help grow this business. Tommy is someone we have been working with for years, and he will run the day-to-day of this new company." The founding partners of FBL Commercial Realty bring a wealth of experience and expertise. Tommy Frankel, with over 4 decades in brokerage and development, has been a pivotal figure in South Florida real estate, playing a significant role in the development of prestigious communities in Palm Beach County. Brad Ball, specializing in luxury homes and club communities, brings over 25 years of experience and a track record of over $1.5 billion in sales. Eric Levitt, with more than 35 years in commercial and residential real estate, owns over 2 million square feet of commercial space and has built a substantial Florida-based commercial portfolio since 2016. Rob Steiner offers over 22 years of experience in commercial real estate, with a focus on landlord representation and site selection for national retailers. FBL Commercial Realty is actively recruiting agents who share its commitment to excellence, integrity, and service. The firm offers an entrepreneurial environment where experienced brokers can thrive, backed by a deeply connected leadership team. Levitt noted the unique opportunity for entrepreneurial business people to join a boutique firm rather than an institutional corporate firm. The company plans to expand its services across leasing, acquisitions, dispositions, investment sales, and asset repositioning, crafting tailored strategies for clients in a rapidly evolving market. In today's episode, we're diving into a discussion hosted by the Charlotte Business Journal focusing on commercial real estate development during volatile times. The conversation, moderated by TJ McCullough, president and publisher of the Charlotte Business Journal, featured insights from industry experts on the current state and future of commercial real estate in Charlotte, North Carolina. Virginia Luther, managing director of commercial at the Spectrum Companies, shared that Charlotte is experiencing a resurgence in office development. After a period of stagnation, developers are once again moving forward with projects, driven by an influx of companies seeking premier office space. Luther emphasized the importance of having available Class A office spaces to attract new businesses to the city. On the other hand, affordable housing development faces significant challenges. Bill Bolstad, executive director of Mosaic Development Group, highlighted the pressures from rising debt, construction costs, and decreasing equity pricing. The conversation revealed that despite the high demand for affordable housing, making such projects economically viable is increasingly difficult. The panelists, including Tim Sidema, managing partner of Crosland Southeast, and Melissa W. Boone of Cohn-Resnick, discussed how rising construction costs and rent expectations impact both office and affordable housing markets. Sidema noted that while office and retail development are seeing renewed interest, the affordable housing sector is struggling to keep pace due to financial constraints. Ryder Mathias, tax partner at Cohn-Resnick, added that the recent passage of the One Big Beautiful Bill by Congress provided some certainty in the tax policy landscape, encouraging developers to reconsider projects they had previously shelved due to economic uncertainty. The experts also explored innovative financing models and partnerships as potential solutions to the challenges faced by affordable housing developers. Bolstad cited partnerships with local governments and educational institutions as crucial in closing the funding gap for these projects. As we look to the future, the panelists expressed cautious optimism about the commercial real estate market. While challenges remain, especially in affordable housing, there is a sense of hope that stability in the economy could lead to more predictable and favorable conditions for development. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.